Hello, this is Kevin Shortell. If you've been following the financial news at all this year, one of the biggest conversations has been around the federal funds rate, and that's an important topic. In fact, as you can see here, new Fed rates are drawing investors to cash, bonds, and notes. Why cash, bonds, and notes? Because they're low risk. The problem is they're also low reward, very low interest coming from those. So why would people do that? Well, it's really out of safety, but you know what? There is one type of secured note that is still paying 8 to 10% interest. So I want to spend a couple minutes talking about that. But let me lead you up to where we are today by taking you through some articles. The first article, I started following this at the beginning of the year. The first article here is CNBC. This is back in February 1st. And look at the headline. The investment that is making the most compelling case in the market right now is cash. Cash. Why cash? Because fear. Fear that rising interest rates could affect the bond market, fear that rising interest rates could affect the stock market, and it will, and it has. Now, interestingly enough, even though cash was the topic here, they did turn the corner at the end of this article talking about bonds and more conversation about bonds where the interest rates will go up and you have that relative safety. The next article I'll bring you about midway through the year from Forbes, July 2nd. Their headline, Why Hold Bonds in the Current Market? And of course, again, the reason becomes to help manage risk, fear, risk. All of this terminology starts to come in there. So what they're recommending is, hey, all that stock market gain that you've made, maybe it's time to cash out of some of that and put it someplace that has more safety to it, like the bond market. The problem is, though, for investors, they're then looking at maybe a 3% return versus whatever they've been getting in the stock market over the year. All right, to bring us more current, this article from MarketWatch, October 30th, cash is king again. But is that also a sign that another recession is looming? So now the fear has gone to recession, interest rates have gone up. So they're saying, yes, cash is back. It's safe. It's a safe place to put your money. And by cash, also they mean cash-like investments. And you can see that on the subheadline there. It says interest rates on 2-year CDs have just cracked 3%. So you can go to the safety of cash or cash-like investments making 3%, trading off high yields for low risk. And that seems to be where people are heading because they want to take some or all of those profits and lock them away a little bit without having to worry. But let's talk about how these instruments work so we can get a better understanding of what that looks like. Okay, when you see articles like this that I just pointed out to you, they're talking about cash, bonds, and notes. So what is cash? Well, I'm going to use the most simplistic example, which is a $100 bill. And a $100 bill, when you really look into it, it is a note. It's an IOU. In fact, it says it right on the bill, Federal Reserve Note. All bills have that. And what does that mean? Well, this note, this IOU, this paper that you're taking in exchange for some debt or obligation is backed by the full faith and credit of the U.S. government. It's not backed by gold or anything like that. It's not backed by real estate, anything like that. It's backed by the full faith and credit of the U.S. government. And we all agreed, and it's on the bill itself, that this note is legal tender for all debts, public and private. So we're using that as the meaning of exchange, and it is in its own form a note, just like writing a check is a note. If somebody writes you a check, that's an IOU, because you could take that check to the bank and find out, guess what? That IOU is no good. There was no collateral backing that. In other words, it was insufficient funds within that account. So what is a bond then? All right, this is an older bond, 1979, but this is a coupon bond that you could get from the Treasury. Look at the interest rate on that bond. You're not going to see that today, right? You're going to see just below 3% today on these bonds. This one happens to be a 15-year bond. Well, what is a bond? What you're doing with a bond is you are lending money to, in this case, the federal government, the United States of America. You're lending them money, and in return, they're going to pay you back plus interest on specific dates. And those are part of the ingredients of an IOU, of a note, of a bond, and obviously of cash. And again, these types of instruments have backing. There is collateral there, and the collateral in this case is the full faith and credit of the U.S. government, which has always performed on these bonds. What about notes? Well, a note is a type of bond. There's a lot of similarities to that. This note is a shorter term note. This is a 10-year Treasury note. And once again, on a Treasury note, what are you doing? You're lending money to the government. They're agreeing to pay you back with interest on specific dates. In fact, on this one, you can see back in 1976, they have these little tear-off coupons on there. And on those dates, you can go and cash those in for your agreed upon interest. And you'll notice United States of America for value received, promises to pay. So these are all the ingredients that these three things have in common. What backs these ingredients, what the collateral is, once again, in the form of a Treasury note here, is backed by the full faith and credit of the U.S. They're promising to pay you back. All right. Now, what does this have to do with the notes that pay 8 to 10%? Let's talk about that one now. So what else is a note? A mortgage note. A mortgage note does all the same things. What is the amount that the person has borrowed? $250,000. What is the date on that? For value received, and somebody is making a promise to pay. All the things that you've seen in those other instruments, they are here, including which I didn't fill in the interest rate and days and the specific periods of time. So all the ingredients here, the specific dates, the value, the promise to pay, they're all in a mortgage note as well. Now here is the difference. This mortgage note does have collateral, but it's not the full faith and credit of the United States government. Instead, it's the property itself. This person is pledging the property as collateral. If they don't pay you back according to the terms of this agreement, and of course the benefit here is you're getting monthly payments, not waiting 10, 20, 15 years, whatever it is, on a bond. You're getting monthly cash flow payments. That's what's agreed upon. Those are the specific dates. But if they don't pay, then we go to the collateral. The collateral in this case is the property itself, and that's what gives you security. Imagine you bought this note for $125,000 and the house is worth $300,000. If they don't pay you, you get back an asset worth $300,000 that you've only paid $150,000 for. Now, that's a much higher rate of return. If they continue to pay on that note and you bought that note for $150,000, we could run through the math. Now, I bet you're getting somewhere between an 8 and 10% annualized return. Secured. So all of the same benefits, better security. In my opinion, you have a real hard asset backing this and a much higher yield. That's why we love the note business.